Hi everyone, good morning. My name is Ravi. I'm the co-founder CEO of Zeef. First of all, thanks a lot for attending this webinar. This is third webinar of the DeFi series. We'll quickly recap what we did in the first two webinars. And today, largely we'll be covering two DeFi use cases. One is decentralized exchange and second is decentralized lending. So under decentralized exchange, we'll talk about what DEX is, how does it work, what is the difference between DEX and a centralized exchange, what are the benefits of DEX, and what are the risks and considerations of DEX that we need to see, and some of the top DEXs that we have seen in last couple of years. And then what is DeFi lending and borrowing? How does DeFi lending work? Difference with traditional lending, benefits, risk, and again, some of the top players in the lending space. So just to recap what we covered in the first two webinars, we talked about what DeFi is, decentralized finance when we say, and how blockchain has enabled this next generation of finance, which is quite distinct and separate from traditional finance. So some of the core tenets of blockchain, whether it be trust, decentralization, transparency, use of smart contracts to enable automation of different processes, etc., is lended by DeFi. And DeFi is playing a major role. It's a small market to start with, but it's growing exponentially. And now, in fact, banks are looking at DeFi very seriously, that how to either involve DeFi within their existing processes or how DeFi is going to disrupt some of the traditional lending process. So starting with DEX. So decentralized exchange is a peer-to-peer marketplace that enables user to exchange and trade cryptocurrencies. So let's start with, I'm sure you must have all used a centralized exchange at some point or the other. So if you go to any centralized exchange, whether it be Binance or Coinbase or WazirX, CoinDCS, etc., there's a process. You need to do a KYC, you need to complete the KYC checks, and then based on your KYC status, you have got a differential availability of how much you can trade, etc. And some of the, in fact, most of the centralized exchanges are where they provide you crypto to crypto trading. So you need to have crypto to start trading there. You can buy and sell. And the buy and sell typically works on a order-based mechanism. So that is an order book concept where, let's say, if you want to buy USDT, selling your 1 Ether, then you need to place a sell order of 1 Ether using the pair Ether-USDT. And then similarly, there must be users who are willing to sell USDT to buy Ether. And then these two orders, the orders in the buy book and orders in the sell book, constituting the whole order book, they are matched with each other and the trading takes place. So this is how a centralized exchange takes place. So you do need to have a KYC, and pretty much if you see, all the trading that is happening on a centralized exchange are off-chain transactions. They are not actually happening on blockchain. So in a case of a centralized exchange, when you deposit a token, Ethereum, BTC or USDT into the exchange, or when you place a withdrawal request to withdraw tokens within your non-custodial wallet, those are the two scenarios where actual on-chain transaction happens. Rest all the trading transactions that are happening on a centralized exchange are custodial, are off-chain transactions. So this is how typically a centralized exchange works. And now I think it will be easy to understand decentralized exchange. So decentralized exchange works typically like any dApp. If you have used NFT marketplace, you go to the marketplace, you connect your wallet. So your wallet becomes your signing tool. You do not need to create an account and then, log it into the account after due verification. In this case, your wallet itself acts as an account and a verification tool. Once you connect your wallet, let's say using MetaMask or Coinbase or various kind of non-custodial wallets which are available. Once you connect, then you can pretty much, start buying NFT. So you connect your MetaMask wallet. In your MetaMask wallet, let's say you have a balance of 1 Ether. You can go to the NFT marketplace, you can connect, and there's an NFT which is available for, let's say, 0.1 Ether. You can simply click on buy, validate and approve your transaction using MetaMask. A transaction goes for your signing. You sign the transaction using your MetaMask, and you get the NFT and the Ethereum is deducted from your account. In the same way, on a decentralized exchange, there's an exchange where you connect your MetaMask wallet. Once you have connected, that itself acts as a login. There's no separate registration process or KYC, AML checks, etc. that is required. And once you have connected, then you see pairs, and you can select. Let's say you want to again, buy USDT using your Ether. You can select in the pair, and I'll show some of the DEXs like PancakeSwap or Uniswap. It's so simple. You select Ether. You select how much Ether you want to sell, and then based on the existing price, it will tell you how much USDT you are going to get. And then you need to sign your transaction using a MetaMask wallet, and then the transaction takes place. That's it. It's as simple as that. And all the transactions on the DEX at that point of time are happening on chain. So as soon as the transaction is done, you can see the transaction on Etherscan or depending on whichever protocol or network you're using to do the transaction on DEX. So DEX is something entirely different from a centralized exchange, and they are completely non-custodial. So you have full security of your funds. There's no chance of any censorship by a centralized exchange, which may be due to some challenges with the other, may freeze some accounts. So all those kind of issues are not there. This is completely inclusive. Anyone across any geography can, go to a DEX and do the transactions. And as I mentioned, all the transactions are on chain, so they are completely transparent. You can see the full history of all the transactions, you can actually trust in those transactions. So if you see a normal process, there's a maker who creates okay, so this is more of a order book. So now coming to the ordering mechanism, or how the transactions takes place. So when we talked about a centralized exchange, we talked about that primarily they work on a order book mechanism, where there are buy orders, sell orders, and then they match with each other. In the case of decentralized exchange, the most common method which is used, or type which is used, is automated market maker, AMM. And so whether we see PancakeSwap or Uniswap, everyone using automated market makers. So I'll quickly show how a market maker works. Now, market maker basically works on the mechanism of a liquidity pool. So on one hand, you have a liquidity pool, and within that pool, there are liquidity providers who provide liquidity. So let's say you have a lot of crypto tokens or crypto coins lying idle in your wallet, and you're not earning any interest on that. So you can become a liquidity provider. You can go to a DEX. Within the liquidity pool, you can provide the liquidity. Now, liquidity in the case of DEX is provided in pairs. So you can provide a liquidity of Ethereum USDT pair or Ethereum USDC pair or any other pairs, whatever pairs are available. And once you provide liquidity, that whatever interest, there will be some interest that will be generated, and you will get access to that interest. So it's another way of earning interest on the cryptocurrencies that are lying idle in your wallet. Now, what happens to that liquidity? How it generates interest that is shared with the liquidity providers? So now, when traders come on the DEX, they put in their request that I want to sell 1 Ether, buy USDT. Then, based on the existing orders which are there, there's a demand and supply. And based on that, the price is calculated. And once you get the price, you confirm the transaction, you sign the transaction using a MetaMask. Then through the liquidity in the liquidity pool, your transaction gets completed. So this is very unlike where we see a buy and sell orders being matched. In this case, your order in a pair is fulfilled by the liquidity pool in the backend. And every DEX charges a certain transaction fee for completing this trade. And a bulk of that percentage, the bulk percentage of the transaction fee is actually transferred to the liquidity providers. So that's how liquidity providers make money, and at the same time, traders can do trading on the exchange. So now if you see what are the differences between decentralized exchange and centralized exchanges. One, as I mentioned, centralized exchange have got the most control because all the transactions are happening off-chain. Whatever cryptocurrencies you deposit, they lie with the admin, they lie with the platform. Platform actually becomes the custodian of those tokens. And there have been instances where, if the custodian has not been managing the tokens very properly, the users may be at loss. Or if they are not managing the cryptocurrencies, not just from a security perspective, but if they are mismanaging it, like they are, it has come to when, crypto market went down a few months back, organizations like Celsius, etc., who were managing users' funds, they did a lot of over leveraging, huge mismanagement of funds, and lot of users have actually lost their funds. So, but yes, if you talk about some of the large ones like Binance, Coinbase, etc., they are quite stable, very large. But there are quite a few smaller exchanges also, where these kind of risks are very high. And but yes, from a user perspective, from a user experience perspective, if you see, centralized exchanges are much more user friendly as compared to a DEX. DEX still, it's magical that you connect your wallet and you simply do a trade. But then not everyone is comfortable using MetaMask. So they prefer going to a DEX, do a normal registration process, because people are normally used to how we use our banking applications. So centralized exchange typically give them that kind of banking or demat account that you have been using. So it gives you pretty much that kind of interface and experience. So people are very much used to it. So from that perspective, centralized exchanges are much more user-friendly. But now as more and more people are getting comfortable with MetaMask and using non-custodial wallets and keeping a non-custodial wallet secure on their end, more and more people are jumping onto decentralized exchanges. Centralized exchanges, of course, provide a variety of features. Most of the, even some of the big ones like Binance or OKX or Coinbase, etc., have started providing tons of other banking kind of features. There is an investment section where you can actually invest. There are staking, savings, different kind of products that are given, because you have deposited your cryptocurrencies there. And even if when you're not trading actively, you will always have some balances of various crypto tokens within your centralized exchange account. And you may want to use them. You do not want to keep them idle. So normally people do is they withdraw and then they put it on some of the DEXs, liquidity pools, or when we come to decentralized lending, we'll see that decentralized lending also has got a liquidity pool, which gives you interest. So there are various options of investment where you can put your idle cryptocurrencies. So now centralized exchanges have also started providing these options where you can stake or you can save and you can earn interest on whatever crypto tokens that are lying idle within your centralized exchanges. Vis-a-vis that, decentralized exchanges provide less features, but they have started providing more. If you go to some of the feature-rich platforms like PancakeSwap, you will find they have farms, they have pools and lottery and various other features that they are coming from time to time. And then as for the liquidity, of course, in the case of centralized exchange, the liquidity is largely managed by the exchanges itself. Again, if you talk about the large exchanges, liquidity normally is not a problem. But when we talk about smaller exchanges, we have seen time and again, a lot of different pairs are not, they are not available because there's no liquidity in the market, etc. So you're not able to buy or sell or do anything with your crypto tokens. Normally it happens with tokens with less liquidity, newer tokens which are not progressing anywhere, and there's not much interest in the community to trade in those tokens. So they typically lose interest, and so those kind of tokens have various liquidity. But that I think is a common problem whether you go to DEX or centralized exchange. And so these are some of the differences between decentralized exchange and a centralized exchange. So right now, different people prefer DEX or centralized exchange based on their preference, their comfort level, and how comfortable they are managing the custodian or non-custodian wallets. So as a benefits of DEX, it is secure, it is smart contract enabled. The smart contracts today are mostly, double audited or triple audited. And the transactions are completely private. There's no KYC. You simply connect your wallet. There are instant transactions, on-chain transactions. So you completely hold the custody of your tokens at each point of time. You're not giving away the custody of your tokens at any point during the DEX transactions. And there's of course a very low fee, very comparative, very low fee, and of course DEX gives you, if you have idle cryptocurrencies lying in your account, it also gives you an option to become a liquidity provider and earn interest on those tokens. Some of the risk, yes, as you know, it's solely based on smart contracts. So smart contracts need to be well audited because there have been hackers who have exploited vulnerabilities in smart contracts and have run away with funds. So of course, smart contract risks are there, and then poor liquidity, as I mentioned, in some of the tokens where there's less interest, less liquidity. If there's a poor liquidity within a pool for a specific pair, then there are chances of having slippage happening, and the transaction may occur, but the transaction may occur at a very odd price, and it may benefit some but incur a huge loss to someone else. And then there are MVP bots. MVE is maximal extractable value bots that can infiltrate the blockchain by paying high gas fee and network fee and exploiting inefficiencies. And we have seen that, it happens from time to time. So sometimes, DEX becomes very expensive from that perspective. But yes, if you talk about most of the common pairs where there's a high liquidity, you will find the prices are almost similar to what you see on other DEXs or other centralized exchanges because of the demand and supply or arbitrage opportunity. So you normally do not face these issues. And then, one of the challenge which was there was scaling issues. So whenever Ethereum was congested, most of the exchanges and DeFi apps being on Ethereum, there was a lot of challenge. The gas fee used to become very high, and the transactions, does not become financially viable. But those scenarios have gone down. One, with the introduction of different layer 1, different layer 2 protocols, whether it be Polygon, Optimism, Starknet, etc. And at the same time, then there are quite a few other blockchain protocols who have started, a lot of DeFi applications have started, have moved on to those protocols, whether it be Avalanche, Solana, Zilliqa, Tron, etc. So overall, the scalability issues are not are getting solved as we move on. So if you see the top 5 DEXs, the topmost is Uniswap. Uniswap started with Ethereum and now has become a multi-chain. So this is again one thing that is happening in the DeFi spaces. That most of the apps they start with one blockchain protocol, but they eventually move on to other protocols. So they effectively become multi-chain, where you can do transactions using different protocols. And there's a Pancake Swap. Pancake Swap was the first one, and it's the major exchange on Binance chain. And again, as I mentioned, it has got quite a rich features, especially farms and pools and various other pieces. 1inch is an exchange aggregator. They also participate in the providing rates using their own liquidity pool. But apart from that, they are an aggregator. They show you all the best options which are available for your trade. And then you can pick and choose and do the transaction. So this was on decentralized exchange. Now coming to DeFi lending. And I think conceptually it becomes easy to understand, because in the case of DeFi lending also, we are using a liquidity pool at the back. And through that liquidity pool, lending happens. So DeFi lending is a platform that offers crypto loans in a trustless manner. And so the way it works is, so there's a lender. Lender is like a liquidity provider, and lender puts the liquidity into, let's say you have again Ether lying idle in your cryptocurrency wallet. So you can go to a lending protocol like Aave or Compound, and you can add Ether as the liquidity there, and it will show you, what percentage, what kind of APY you will get out of your liquidity, typically based on the lending transactions happening as of today. So so you can deposit that liquidity, and then somebody who wants to borrow can come in and they can borrow assets from that liquidity pool, and they need to pay interest on top of it. Now, since it is completely smart contract enabled, there is no KYC. Of course, all the lending that happens in the DeFi, except for few new ventures who have come in, who are now talking about unsecured lending. But if we talk about Aave, MakerDAO, Compound, etc., all are collateralized lending. And the collateralization ratio is also very high because of the volatility of cryptocurrencies. We know that, the cryptocurrencies can be very volatile, losing substantial value in terms of percentage. And so if you put in a collateral of, let's say, Ether worth $1,000, if the value of Ether goes down by 60%, 70%, the value of your collateral can become 300 or 400. So that's why there's a high collateralization ratio that typically is there. And with more popular cryptocurrencies, the ratio is typically lower. With less popular, wherever there's less liquidity, the collateralization ratio is even higher. So the way it works is, as a lender, you typically interact with the liquidity pool contract. You provide your crypto token as a liquidity, and you earn interest on it. And from a borrower perspective, let's say you have Ether in your account, and you want to you don't want to sell Ether because you're bullish on Ether. You want to retain it, but at the same time, you want to use that Ether as a collateral and borrow some USDT so that you can do some transactions that you want to do. So in that perspective, you come in as a borrower, you connect your wallet, you select Ether as a collateral, and then you can it will show you based on collateralization ratio that if you deposit Ether worth, let's say, $1,000, then you get USDT worth $600, for example. So you deposit your Ether worth $1,000, you get 600 USDT in return, and then you can use those USDT whichever way you want. And whenever you return back those 600 USDT, you can get your Ether back. So it's as simple as that. And during the time when you have taken this loan, let's say the value of Ether goes down, and due to which your $1,000 collateral is worth only $800 or $750. So before it hits 600 or even go lower, there is a specific mark, which is, a liquidation mark. So a call is made to the borrower. Borrower has to either deposit some USDT back or deposit more Ether to maintain the collateralization ratio. If you don't do that, then a liquidation event can happen. And during that liquidation event, your Ether will be liquidated and the account will be settled. And you may incur a loss. Plus also in the first place, you never wanted to sell that Ether. So one need to take care of the liquidation events. It's very much similar to, in the traditional lending where you do a default and the bank can actually sell your collateral in the open market to recover whatever pending balance is. The same way it works in the DeFi space. There are third-party liquidators who basically liquidate, and they are rewarded for that. And the borrower is penalized for. So apart from losing value, you also are penalized for liquidation. So there may be some percentage added to the loss as a penalty. So this is Aave model. So initially when DeFi lending started, there was a startup called Ethlend. It was very much similar to the traditional where, there were lenders and borrowers and matching was used to happen. But then, Ethlend evolved into Aave with a lending pool concept, because that's much more efficient. And in the case of buying matching, there are a lot of challenges. I'm not getting into those, but you need to match borrowers, suppliers, lenders, and their needs and preferences need to match, etc. So here it's a very neat concept. You have a liquidity pool. The lenders get some, APR or APY, and the borrowers pay a certain interest depending on what token they are taking, what collateral they are giving. So everything is very well defined, run based on smart contracts. So that's how typically a DeFi lending works. What are the differences between DeFi lending and traditional lending? DeFi lending occurs on the blockchain, making it instantaneous. So all the transactions are on chain. There's no third party. And traditional lending, we know, involves a lot of paperwork, intermediaries, and of course, there's it's not very inclusive also. There are a lot of limitations in terms of what is your credit score and what geography, whether you are part of the banking system or not. And of course, it's completely non-custodial. DeFi lending, again, as in Decentralized Exchange, DeFi-based lending is completely non-custodial. So you own your tokens. Whenever, even if you have provided your token as a liquidity provider or as a collateral as a borrower, in both cases, when you provide liquidity, you get liquidity provided tokens. They are like a receipt to the tokens that you have provided. So at all point of time, you yourself as the custodian, you can always give back the liquidity provided tokens and get your liquidity back at any point of time, whenever you decide. So it's as simple as that. So as you see, it becomes very magical. You cut down a lot of intermediaries, buyers and borrowers and lenders are interacting with each other directly through a pool-based system. And you simply connect your wallet. You have all the transactions on chain, trust and transparency is there. And at the same time, you have complete control over your funds. So user remains anonymous as there's no compulsion to reveal identity. But yes, of course, now DeFi lending itself is evolving as the tokenization market is evolving. So till now, when we talked about NFTs or fungible tokens, we were talking mostly about digital assets or collectibles, etc. But now, the whole tokenization space is getting disrupted by getting into real world asset tokenization. And when those real world tokenized assets, they come on DeFi lending, of course, they will come with some compliance and regulations where KYC, etc. will become important. So newer platforms, one of the blockchains that we are working with, DCOM, is highly attuned to real world asset tokenization. So we'll see a next version of DeFi where tokenized real world assets are going to be traded on the DeFi, within the DeFi space, lending, exchanges, everywhere. User can verify the terms and specification of the smart contracts. All the smart contracts are open, as is the concept of DeFi. So as we talked about in the first two webinars, that all the contracts are open for audit. And that is the beauty of it. So not just from a trust and transparency perspective, but the thing is you can actually take those smart contracts, modify them and use them, create new products or new process out of them. So it saves a lot of time for the new players to get into. And at the same time, you can, these smart contracts are composable. So you can connect with other smart contracts. You can talk to the other smart contracts using the common token and common standards. And there's immutability of lending process transactions because all the transactions are on chain, and so they are secure, tamper-proof, and there are less of intermediaries, so they are not required. And the best part is that the APY is very low. If you go to Aave, and if you talk about the more popular cryptocurrencies, the major top 50 cryptocurrencies, you'll see the APY is 5 to 8%, sometimes even less. So that makes DeFi loans very attractive, especially if you have a holding of cryptocurrencies that you do not want to sell, but at the same time you want cash for some trading, some transactions, or for any other purpose. DeFi loans becomes a very attractive proposition to do that. What are the risks? One risk is common, as I mentioned, about smart contracts, and we have seen in the case of lending also. If the smart contracts have not been well audited, if there are vulnerabilities that can be exploited, hackers have done that, and the funds come at risk. Rug pools, again, so you always need to be wary about new DeFi lending platforms, especially dealing in some of the low liquidity or highly illiquid tokens. So a lot of rug pool schemes can happen here because the market is open. It's not regulated by third-party agencies. So of course, so you need to be wary about these kind of scenarios that people do. But rug pools, have been frequent in the case of DEXs as well as DeFi lending. And we briefly talked about scalability. The same thing is applicable here, but as we mentioned, more L1 protocols like Avalanche, Tcom, Solana, etc. coming in, and more L2 protocols like Polygon, Optimism, etc. coming in. Of course, the scalability issues have been resolved to a larger extent. If you see the top 5 lending platforms, Aave being one of the most popular, Compound, and then there's a Solend, which is actually a lending protocol on Solana. And then this MakerDAO, and then InstaDApp, which is a Indian-born startup. They are very interesting startup. They provide a very smart wallet for DeFi where you can manage your portfolio, but not just that. The best part is that you can write workflows and create different transactions, connect those transactions across different DeFi apps using InstaDApp. So in terms of stats, the DeFi market is growing very rapidly, except for last 3-4 months, the crypto winter. But the total value logged is more than 38 million, and the global market, blockchain market is expected to cross 65 million. So 65 billion, sorry. So DeFi is going to grow huge in terms of total value logged, in terms of number of transactions happening, and more people resorting to DeFi transactions. So this is pretty much I wanted to cover. Thanks a lot for attending today. And so we'll conclude this DeFi series in the next webinar, where I'll be talking about, today we covered 2 of the major use cases in DeFi, but we'll cover a few other use cases in the next series, in the next webinar of the series, last of the series, stable coins and algorithmic coins, etc. And that will conclude the DeFi series. If you have any questions, do connect us on LinkedIn, Telegram, or Twitter. Join our community, join Zeev platform. Again, Zeev is a Web3 infrastructure as a service platform that provides elastic APIs, automated deployments of blockchain nodes, validator nodes, full nodes, etc. So kickstart your Web3 journey with us. Join our community. Thanks a lot.